Welcome to Simple Investing Secrets. In today's video, we'll take a look at the top 12 monthly dividend stocks to buy in 2023. So before we get started, please like this video and subscribe to our channel for weekly updates. Let's get started. Your bills come monthly. Why not your dividend checks? Monthly dividend stocks are a game changer for income investors. For all the changes we've experienced in recent years, some things remain regrettably the same. We all have bills to pay, and those bills generally come monthly. Whether it's your mortgage, your car payment, or even your regular phone and utility bills, you're generally expected to pay them every month. While we're in our working years, that's not necessarily a problem, as paychecks generally come every 2 weeks. And even for those in retirement, Social Security, and if you're lucky enough to have one, pension payments also come on a regular monthly schedule. But unfortunately, it doesn't work that way in our investment portfolios. And that's where monthly dividend stocks come into play. Dividend stocks generally pay quarterly, and most bonds pay semi-annually or twice per year. This has a way of making portfolio income lumpy, as dividend and interest payments often come in clusters. Monthly dividend stocks can help smooth out that income stream and better align your inflows with your outflows. We'd never recommend buying a stock purely because it has a monthly dividend, says Rachel Klinger, president of McCann Wealth Strategies, an investment advisor based in State College, Pennsylvania. But monthly dividend stocks can be a nice addition to a portfolio and can add a little regularity to an investor's income stream. Today, we're going to look at 12 of the best monthly dividend stocks to buy for 2023. You'll see some similarities across the selections. That's because monthly dividend stocks tend to be concentrated in a small handful of sectors, such as real estate investment trusts, REITs, and business development companies, BDCs. These sectors tend to be more income-focused than growth-focused and produce yields that are vastly higher than the market average. But in a market where the yield on the S&P 500 is currently 1.7%, that's certainly welcome. The list isn't particularly diversified, so it doesn't constitute a full portfolio. In other words, you shouldn't buy too many stocks with monthly dividends. But they do allow exposure to a handful of niche sectors that add some income stability, so take a look and see if any of these monthly payers align with your investment style. With that said, let's review our top 12 best monthly dividend stocks to buy in 2023. Number 12. SL Green Realty Corporation, ticker, SLG. SL Green is a REIT that invests in office buildings and shopping centers in New York City and is Manhattan's largest office landlord. As of October 2022, the company held interests in 64 buildings totaling 34.4 million square feet. SL Green is based in New York City and was founded in 1997. The company's dividend yield as of December 2022 was 8.96%. Number 11. Ellington Financial Incorporated, ticker, EFC. Ellington Financial is a mortgage REIT that invests in residential loans, commercial mortgages, and commercial loans. A large portion of its portfolio consists of residential mortgages. The company says it focuses on underserved, niche market segments where it believes it has identified market inefficiencies that provide opportunities for investment. Ellington has since steadily built its dividend back up to its current level of 15 cents per share per month, in line with pre-pandemic levels in 2019. The company's dividend yield as of December 2022 was 13.6%. Number 10. Broadmark Realty Capital Incorporated, ticker, BRMK. Broadmark Realty Capital is a REIT that helps real estate investors and developers get the money they need. The company offers first deed of trust loans that are short-term and backed by real estate. These loans can be used to buy, fix up, or build residential or commercial real estate. Since its start in 2010, Broadmark has completed more than 2,000 transactions and used $4.1 billion in capital. The company has a loan portfolio worth $1.6 billion that is active and spread out across 24 different states. There are 234 active loans in the portfolio, and the average loan size is about $7 million. The company's dividend yield as of December 2022 is 15%. Number 9. Realty Income, ticker, O. Market value, $39.0 billion. The yield on the dividend as of December 2022 was 4.7%. The conservative triple net retail REIT Realty Income may be the stock with the most monthly dividends in the history of stocks. As its official name, the company trademarked the monthly dividend company. Realty Income is a stock and its share price can be just as volatile as any other equity. But it's still as close to a bond as you're going to get in the stock market in terms of the safety and reliability of its payout. It has stable, recurring rental cash flows from its empire of more than 11,700 properties rented to more than 1,100 different tenants in nearly 80 different industries in all 50 states, Puerto Rico, the UK, and Spain. O focuses on retail properties with a lot of foot traffic that are usually safe during a recession and, perhaps more importantly, are Amazon.com proof. Perhaps no business is completely free of the risk of competition from Amazon.com and other e-commerce titans, but Realty Income comes close. Its largest tenants include 7-Eleven, Dollar General, and Lowe's, among others. More than a quarter of the portfolio is in grocery stores, dollar stores and convenience stores, all of which tend to be pretty recession-proof or in some cases, actually benefit from trading down in a recession. That's good because, with the yield curve inverted as it was for much of 2022, a recession in 2023 is a real possibility. At current prices, Realty Income yields 4.7%. That's not a monster windfall, but it's much more than both the broader market as well as 10-year treasuries, with the latter yielding 3.5%. It's not the raw yield we're looking for here but rather income consistency and growth. As of December 2022, Realty Income has made 629 consecutive monthly dividend payments and has raised its dividend for 100 consecutive quarters, making it a proud member of the S&P 500 Dividend Aristocrats. Since going public in 1994, Realty Income has grown its dividend at a compound annual growth rate of 4.4%. While that's below the rate of inflation today, it's well ahead of inflation over the duration of that period. And regardless of whether the Fed manages to get inflation under control anytime soon, Realty Income's history suggests it should be able to keep its dividend growth rate ahead of inflation. Number 8. Stag Industrial, ticker, STAG. Market value, $5.9 billion. The yield on the dividend as of December 2022 was 4.4%. Realty Income is pretty darn close to Amazon.com proof, but fellow monthly dividend payer Stag Industrial proactively benefits from the rise of internet commerce. Stag invests in logistics and light industrial properties. You know those gritty warehouse properties you might see near the airport with 18-wheelers constantly coming and going? That's exactly the kind of property that Stag Industrial buys and holds. E-commerce is growing by leaps and bounds, which is a given, and Stag is set up to take advantage of this. Roughly 40% of Stag Industrial's portfolio handles e-commerce fulfillment or other activity. In fact, Amazon.com is Stag's largest tenant. E-commerce spiked during the pandemic for obvious reasons. And while stores have reopened over the past 2 years, the effects of that initial spike have dissipated somewhat. Still, the trend toward e-commerce is clear, and likely to stick around. We're making a larger percentage of our purchases online, and that trend only goes in one direction. However, there's still plenty of room for growth. As crazy as this might sound, fewer than 15% of retail sales are made online, according to the US Census Bureau. Also, there are a lot of different logistics companies and Stag's management thinks their market is worth around $1 trillion. In other words, it's unlikely Stag will run out of opportunities anytime soon. Stag Industrial isn't sexy, but it's one of the best monthly dividend stocks to buy for 2023, with plenty of growth ahead of it. And its 4% plus yield is competitive in this market. Number 7. Gladstone Commercial, ticker, GOOD. Market value, $755.4 million. The yield on the dividend as of December 2022 was 8.1%. For another gritty industrial play, consider the shares of Gladstone Commercial. Gladstone Commercial, like Stag, has a large portfolio of logistical and light industrial properties. Approximately 54% of its rental revenues come from industrial properties, with another 42% coming from office real estate. The remaining 4% is split between retail properties, 3%, and medical offices, 1%. With such a diversified portfolio, the crazy volatility of the last few years hasn't been too hard to handle. As of September 30, 2022, the REIT had a portfolio of 137 properties spread across 27 states and leased to 112 distinct tenants. Since 2012, Gladstone Commercial has grown its portfolio by 15% every year in a steady planned way. Its occupancy stands at 97.0% and has never dipped below 95.0%. Its largest tenant makes up only 4% of its portfolio, and nearly half of its tenants are publicly traded companies. That's not a bad run. Gladstone Commercial is also one of the companies that have paid a dividend every month since January 2005, without fail. What's more, company currently yields a juicy 8%. Number 6. EPR Properties, ticker, EP. Market value, $3.1 billion. The yield on the dividend as of December 2022 was 8.1%. 2022 was a year of adjustments. It was painful in the stock market, as we had to contend with the normalization of monetary policy by the Fed and the elimination of a lot of pandemic-era aid. But it also brought a lot of normality back to our lives. And as we get ready to enter 2023, that should be positive for EPR Properties. EPR owns a diverse and eclectic portfolio of movie theaters, amusement parks, ski parks, eat and play properties like Topgolf, and a host of others. EPR specializes in experiences over things, which should be a major tailwind in 2023. We gorged ourselves on stuff during the pandemic. But what we've frequently done in the absence of our interactions with friends, family, and coworkers. And the more we reintroduce these things into our lives, the more EPR's tenants stand to benefit. Prior to the pandemic, the company was a consistent dividend payer and raiser. But with its tenants facing an existential crisis, EPR eliminated its dividend in 2020. That cut was short-lived, however, and the REIT reinstated its monthly dividend in July 2021, and then raised it in March 2022. The shares now yield an attractive 8.1%. EPR is not without its risks. We may be entering a recession, and when times get tough, discretionary spending often takes a hit. Inflation doesn't help on that front either, nor does the tight labor market, which makes it difficult to find help. And EPR has a large allocation to movie theater properties, and movies have been slow to bounce back to pre-COVID levels. Still, if you're willing to take a modest amount of risk, EPR is a nice potential turnaround play with an attractive yield and the potential for significant dividend growth in the years ahead. Number 5. LTC Properties, ticker, LTC. Market value, $1.6 billion. The yield on the dividend as of December 2022 was 5.7%. For one final traditional REIT, consider the shares of LTC Properties. LTC is a REIT with a portfolio roughly split equally between senior living properties and skilled nursing facilities. During the pandemic, it was clear that the people who lived in the REIT had a hard time since the increased risks made senior living and nursing homes less appealing. And the national labor shortage has only added fuel to the fire. It may be a while before the industry returns to full pre-pandemic health. But the long-term demographic trends here are just about unstoppable, and LTC is an attractive turnaround play in 2023. Senior living properties aren't as affected by the lack of workers and the fear of viruses because most of their tenants are younger and don't need medical care. They also offer an attractive active lifestyle for many seniors, and that hasn't fundamentally changed. With the vast majority of baby boomers now retired or empty nesters, the case for investing in senior living properties almost speaks for itself. Skilled nursing may take a little longer to fully recover. Home care might be a viable option for many seniors who need assistance but either can't afford it or who are reluctant to live in a nursing home. But ultimately, there comes a point where there are few alternatives to the care of a nursing home. Importantly, the longer-term demographic trends here are supportive of growth in LTC. The peak of the baby boomer generation is in its early to mid-60s today, far too young to need long-term care. But over the course of the next 2 decades, demand will continue to build as more and more boomers age into the need for these services. And at 5.7%, LTC is one of the higher-yielding monthly dividend stocks on this list. Number 4. AGNC Investment, ticker, AGNC. Market value, $5.6 billion. The yield on the dividend as of December 2022 was 14.8%. AGNC Investment is a REIT, however it's very different from the likes of Realty Income, Stag, or any of the others covered on this list of monthly dividend stocks. Rather than own properties, AGNC owns a portfolio of mortgage securities. This gives it the same tax benefits of a REIT: no federal income taxes so long as the company distributes at least 90% of its net income as dividends, but a very different return profile. Mortgage REITs, also known as M-REITs, are designed to be income vehicles, with capital gains not really much of a priority. As such, they tend to be monster yielders. Case in point, AGNC yields 14.8%. There's a reason for that. AGNC invests exclusively in agency mortgage-backed securities, meaning bonds and other securities issued by Fannie Mae, Freddie Mac, Ginnie Mae, or the Federal Home Loan Banks. This makes it one of the safest plays in this space. The sudden spike in interest rates in 2022 wreaked havoc on a lot of income investments, particularly mortgage REITs like AGNC. But the stock appears to have bottomed out in October and has been trending higher ever since. Unlike equity REITs, which are backed by real properties, mortgage REITs really are at the mercy of market yields. If the yield curve remains inverted for much longer, AGNC might be at risk of a dividend cut. Dividend cuts are common in this space. Still, with a yield of almost 15%, AGNC could trim back its payout and still sport a very competitive yield. Number 3. Dynex Capital, ticker, DX. Market value, $597.58 million. The yield on the dividend as of December 2022 was 11.9%. Along the same lines, let's look at Dynex Capital. Like AGNC, Dynex is a mortgage REIT. Approximately 94% of its portfolio is invested in agency residential mortgage-backed securities bonds made out of the mortgages of ordinary Americans, but it also has exposure to commercial mortgage-backed securities and a small allocation to non-agency securities. It's important to remember that the past several years have been a roller coaster for the mortgage REIT sector. During the chaos of the pandemic, many mortgage REITs lost a lot of money, and some even went out of business. Dynex is one of the survivors. And frankly, any mortgage REIT that could survive the chaos in the bond markets of recent years is one that can likely survive the apocalypse. Dynex trades at an 11% discount to book value and sports a juicy yield of nearly 12%. We could see some more volatility in the space as the Federal Reserve continues to push rates higher, but for now, this looks like one of the best monthly dividend stocks to buy if you're looking for a seriously high yield. Number 2. Main Street Capital, ticker, MAIN. Market value, $2.9 billion. The yield on the dividend as of December 2022 was 7.1%. Business development companies, BDCs, are the places where Main Street becomes Wall Street. BDCs provide debt and equity capital mostly to middle market companies. These are entities that have gotten a little too big to get financing from bank loans and retained earnings but aren't quite big enough yet to warrant an initial public offering. BDCs exist to bridge that gap. The appropriately named Main Street Capital is a best-in-class BDC based in Houston, Texas. Like some of the stocks on this list, Main Street is something of a turnaround play. The last 2 years were not particularly easy for Main's portfolio companies, as many smaller firms were less able to navigate the lockdowns than their larger peers. But the company persevered, and today it is stronger than ever. Main Street's monthly dividend plan is conservative because it pays out a small dividend each month and then uses any extra money to give out special dividends twice a year. This keeps Main out of trouble and keeps it from having to cut its dividend in years when its earnings might be temporarily low. As far as monthly dividend stocks go, Main Street's regular payout works out to a respectable 7.1%, and this does not include the special dividends. Main Street raised its monthly dividend earlier this year and managed to throw in an additional 17 cents per share in special dividends. A recession might slow down additional growth and special dividends for a few quarters, but don't expect it to slow Main Street down for long. Number 1. Prospect Capital, ticker, PSEC. Market value, $3.0 billion. The yield on the dividend as of December 2022 was 9.3%. For another high-yielding, monthly paying BDC, consider the shares of Prospect Capital. Like most BDCs, Prospect Capital provides debt and equity financing to middle market companies. PSEC has been publicly traded since 2004, so it has proven to be a survivor in what has been a wildly volatile 2 decades. Prospect Capital is objectively cheap, as it trades at just 77% of book value. Book value itself can be somewhat subjective, but the 23% gives us a good degree of wiggle room. It's safe to say the company, even under conservative assumptions, is selling for less than the value of its underlying portfolio. It also has a very healthy yield of 9.0% or higher. As a general rule, insider buying is a good sign. When the management team is using its own money to buy shares, that shows a commitment to the company and an alignment of interests. Over the course of the past 2 years, the management team bought more than 31 million PSEC shares combined. These weren't stock options or executive stock grants. These are shares that the insiders bought themselves in their brokerage accounts. Today, CEO John Barry owns a whopping 69 million shares. This concludes our list of the top 12 monthly dividend stocks to buy in 2023. As always, do your own due diligence and research before buying any stocks or investing in the market. And don't forget to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching and best of luck with your investments.